Well, good afternoon. We'll try to get started, so we'll get you out to lunch on time. The panel today is a little different than originally scheduled, but we have a very fascinating group of people. Pierre actually is, I think, the first time we've ever had a fund trader participating. Pierre comes from the physical paper world before he went into the fund business, so it'll be interesting to hear his perspective. Chris is with Vitol. Vitol is by far the largest energy commodity merchant in the world, and he's been around the various spots in the industry also in trading, from Philip Brothers to BP to Vitol. And of course, the good doctor needs no introduction with his very large brain. So to get started, I'm going to show you a couple slides. If you've seen me do this before, this is sort of where the rubber meets the road. You know, the slides are really representing what I'll call futures prices that are very transparent. They're a little dated. You know, they were last week, so they're $10 lower, if you will. But if you look at the difference between Brent and TI in the quantitative world, where you sort of had a mean reversal back to the $80 level, these two markets are sympathetic, not parallel. If you've watched the WTI Brent spread over the last couple years, they tend to trend, but they have some slightly different characteristics that we all see. This is the combined open interest and volume in the markets. Open interest has increased dramatically in crude oil futures the last 5 years, with a high of approximately 4 million lots. Okay, part of this is the exit of the banks as more people directly use futures markets, more hedging activity. The most interesting part about this is volumes have been relatively stable even with the increase in open interest, which is highly unusual. Okay, and in the recent price trend, you've seen open interest come off, which technically is long liquidation. And here that looks like in WTI prices, that open interest has come off in long liquidation. We've recently seen an increase in open interest in both Brent and WTI, that we've seen a lot of put activity, put options, as people are doing guaranteed revenue enhancements. It was mentioned in a couple of the other panels, some of the independent operators in the United States for various contract and banking obligations have heavy profiles and must participate in these type of markets. All right, Brent is the same thing. As you see, there's been a light jump in open interest as it breaks the $90 mark. Okay, you can say that is new shorts entering the market. There's been a little of that under the $90 price level, and also some increased hedging activity. This is, I think, the most important thing to really look at as a old commodity merchant. It's not necessarily the spot price, but the slope of the curve. So in WTI, we've seen what was basically a flat market 2 years ago to a highly backwardated market from the 110 level into a slight backwardation in the front. That's the characteristics of WTI in the United States, primarily around the Cushing location of delivery. But the most interesting part is all the volatility is in the front end of the market, not the back end of the market. Okay, so you can say from this chart that the market still is demanding a premium for 3, 5, 7-year oil out over current spot prices. The Brent curve is a little bit more dynamic in that the steep backwardation that we've incurred over the last 2 years has now formed into a contango. Okay, and we're going to actually talk about, you know, our current price formation, and is this going to lead to a start of stockpiling and supplies, because the forward price curve actually pays you to stock oil at these prices. Okay. Chris is going to make a couple comments here for us that should enrich our conversation. Please.
Yeah, thank you very much. So just a few slides that I thought I'd throw in there for discussions. One of the things that we've been focusing on recently has been the decrease in real demand. So forecast demand versus actual demand has continued to underwhelm. And this graph continues to show that the main energy agencies, IEA, OPEC, US DOE, are continuing to call for in excess of 1.1, 1.2 million barrels a day of demand next year. And the reality on the ground today is that actual demand has been, one can debate it, but for argument's sake, it's about half that at 600,000 barrels a day. And the IEA estimates month on month from January till today are starting to reflect that. That obviously is one side of the equation. We're going to touch on the supply side just shortly. But one of the things that the sustained period of over $100 oil for 3 years has done is actually bring in some other efficiencies. One of the things that was of a surprise to me on one level was just on the shipping markets. We've seen a massive increase in vessel efficiency, not only through slow steaming or better trim, and I didn't realize it could make that much difference to the efficiency of a vessel, but the same vessel ordered from the same yard 2010 versus 2011, and we ordered one each year. The one the year following had a 15% lower fuel burn than the one the year before, and that's without major re-engineering or design. And I think that's just endemic of what's happened with higher prices. We've seen an 18% gain in the US car fleet. We are seeing another big trend that I think is something that we can maybe touch on briefly, is the relative value of hydrocarbon versus gas. And the alternative are going to be more forthcoming in the next few years in terms of incremental LNG. We're seeing massive LPG exports off the Gulf Coast, and there's the ethane story, which has been quite interesting of recent, starting to see some fairly large shipments of ethane too out of the Gulf Coast into the Indian and European crackers. And lastly, on the airline side, the design of the much heralded 787, which is finally flying now, and the A380, these are much more efficient aircraft, and I think that's part of that demand story. Also, part of that story too is we're seeing in China year on year, and this is just one element obviously of the Chinese slowdown story, but year on year, quarter by quarter, the reduction in incremental gas oil demand. Gas oil demand obviously is a driver, and we saw that in the growth in the Middle East demand in 2006, 2009, or 2005, 2009. It was a real indicator of construction and construction activity, and that seems to have been dying down quite dramatically. In fairness, this chart is 1 month out of date, and there was a small upturn beyond what's shown here, but the trend is quite clear. And lastly, and it was touched on in the presentation by Bob Dudley, is the preponderance of technology on new production or unconventional production. And here, in terms of the amount of oil recovered by rig, by drill, this is for the Bakken, which is, as you know, one of the shale developments in North America. But it's quite a compelling story on the supply side. So the thought, how sustainable this is through 2030 and beyond, we don't know, but it is a very strong indicator that whatever increases in production we've seen in some of the non-conventional areas is certainly accelerating, and from a cost point of view, obviously getting a lot more effective.
Thank you, Chris. I guess to start off, one comment, commodity merchants always talk about is high prices cure high prices. Low prices cure low prices. And we've heard some conversations about that this morning on, is the current price level sustainable? What's it do to future investments, access to capital, et cetera? What do you think? Is this low price going to cure itself?
I think that it's going to go a lot more lower before it begins to cure itself. I look at the markets like a traffic jam in Bombay. And there's a policeman there directing the traffic. The policeman decides, I don't want to direct the traffic, so the cars crash. And there would be need for a policeman to be brought in to direct the traffic again, but there has to be a lot of pain and suffering before that happens. So my expectation is to see a lot lower prices before the pain becomes great. And it takes time, 6 months, 9 months. It will cure itself. But I don't think if you're going to go back to the good old days. I mean, people were in the $100, $110 oil price. They thought that it was the market. It was managed so well. It was a beautiful management of the market. It was not where the prices belonged. That era is gone. We're going to move a notch lower. What's the notch? $20, $30 lower. But before we get to that stable level, we need to go even more until need for the traffic cop is there. The policeman is brought back in there to direct the traffic.
Well, staying on that, who is the traffic cop? Is the capital market, the lack of financing for new? Is it OPEC? Do they have to be together?
I think the traffic cop is OPEC, and personification are the brilliant management of the Saudis in the system. It is really, the word always is that I will supply what the market needs. That's sort of a correct statement, but it is really the sort of brilliant management of the market which has taken place. And people thought that prices should be there. They forgot that actually it doesn't belong there. It was there because it was done so nicely, and with the help from Iran sanctions and Libya problems and a variety of other things helped it. But it actually, people forgot that it doesn't belong to that $100, $110 range forever. And now everybody's shocked. How is that possible for that to come down? Actually, it should have happened before. It was just so nicely managed that it didn't happen.
Okay. Pierre, how do you think about this market structure now? And
no, I think I agree. I mean, I'd like to speak a bit about what happened over the last few years, why we stayed at $110 a barrel for 3.5 years. I think the main reason is that we had this increase in shale oil production in the US was masked by large supply disruptions in North Africa and Middle East, and with the effect of the so-called Arab Spring spreading from country to country and having an impact on production. From main countries, obviously Libya and then Syria, and impacted a little bit of Iraqi production, and the sanctions on Iran. So we lost, 3.5 million barrels a day of production from early 2010 to early 2014 from all these supply disruptions, and that was met by an increase of equivalent. About the same amount from shale oil production in the US. So it kind of canceled each other. And then then we had a bit of demand growth around 1 million barrels a day per year that was met by OPEC increasing production because they had spare capacity after the financial crisis. Now where are we? We're in a market where supply disruptions in the last few months haven't kept on going up, but actually they've been going down. So we had some oil coming back from Libya. That was quite unexpected given the chaos in the country. None of us expected it to last more than a few weeks, actually. And that's still, we'll see how sustainable that is. And then we had a bit more oil from Iran due to the sanctions being, not necessarily being a bit more relaxed, I would say. And so far, we haven't had supply disruption from Iraq despite what's going on with ISIS, and no impact on production from Russia, from the Russian-Ukraine situation, because it's more of a long-term issue. And I think somehow it might have impacted demand more than supply, because European demand might have taken a little bit of a hit from all the sanctions in every direction, actually, over the last few months. So now, basically, prices went back down because the growth in shale oil production stays unabated and keeps on getting higher than people expected. So if we look at, in June, what people expected, we expected 1.3 million barrels a day supply growth from the US, and the last estimates are around 1.7 million barrels a day, so it's roughly 400,000 barrels a day more. We get Libya production is like 500,000 barrels a day more than what it was in June. And then demand has been, much lower. So it's, as Chris said, it's the latest estimates for this year is around 600,000 barrels a day, and the expectations were 1.3 or 1.4 million barrels a day in January, and still, 1.2 like as of June. So we had roughly a 2 million swing in supply-demand balance from June to now, and that's why prices came off. Now, if we look at 2015. we're in a market where, if we stay at relatively high prices and US growth stays around 1.5 million barrels a day, and Libya stays at current production, and Iran goes up a bit. Iraq goes up, Brazil is going up now. Finally, we see the impact of pre-salt basin production. So Brazil has been going up 200,000 barrels a day this year, and will carry on to do so. Then we should have at least a 2 million barrels a day oversupply next year. If US shale oil production stays very strong, similar to 2014. And so obviously that will not happen. Something has to happen for inventories not to go up by 2 million barrels a day for a long period of time, because within 6 months you have no more storage capacity actually to fill if you have 2 million barrels a day built for 6 months. So what has to happen? Will OPEC? But who's OPEC now, really? I mean, we have OPEC is really core OPEC. You have Saudi, Kuwait, and UAE. If they have to take the hit, only the 3 of them, then they would have to cut 2 million barrels a day next year, and then an extra 1 and a bit the following year, and then an extra 1 the following year. All that to actually, and if they do that, what would happen? You would have US production growth would stay very strong. And demand growth, we would carry on having high efficiency gains, and so we'd have low demand growth. So they would just shoot themselves in the foot by keep on cutting production and not being able to stop prices going down. So I don't think they can be the only guys cutting and to stabilize the market. I think US production growth has to slow down, or we need to have. We don't really need it, but there would need to be more supply disruption from large producing countries, and that's a big unknown. It might happen, it might not. Hopefully not, obviously. So it's going to be a dynamic market, and for now, when I look at the marginal cost of production of shale oil, and I look at what people were saying in natural gas in 2008, at the time, I remember in the market we were speaking about $7 an MMBTU as a marginal cost of production, and now it's down to 3. And if it's the same for oil in the US, we keep on having supply growth being higher than expected, then I think we're going to be in a bear market. I think we'll see much lower prices, and that will bring some demand growth back to the market, because people won't be that efficient with demand anymore. And supply growth will go down, and eventually that will plant the seeds for the next rally. But I don't see how you can have a very stable market for very long. And I think the period that we've had over the last 3.5 years, it was really by chance that the market was stable. It's only because there were large supply disruptions that was masking this shale oil production growth. And so I think at the end of the day, there's no stable oil price that can last for the next 10 years. We'll have some periods of lower prices, higher prices, and I think we'll go lower before we go higher again. And I don't think, because demand is so inelastic. If we basically 10% move in prices has an impact of maybe 0.15%, in demand. So it's not.
You should be like OPEC. He's already exceeded his quota.
So, Chris, let me change it a little bit from a merchant perspective. If we have this overproduction, for lack of a better word, and the market is in a contango, is there an ability for the contango to take some of the supply and put it in storage? Does that slow or start to balance or put a floor in prices here?
Oh, yeah, I mean, on the short to medium term, obviously, if you get the right pricing incentive, the market will react and store. We haven't seen a huge amount of it yet, but it feels like it could go that way, especially by Q1 next year.
Yeah. So I think of storage as arbitrage levels. You can put them in a tank at X, a boat at Y, and something else at Z. And there's financial capacity. Basically, it's a finite space. Has the change in the bank's participation, whatever that means in the market, is that affecting, or would that affect storage?
No, I don't think so. I think this is so you could attain collateral fairly easily for oil. So from a financing point of view, the capacity is there to do it if the market allows it to happen. You have logistical issues, and you have market-related issues as to where you can put it and how much you can logically store. But from a financing point of view, banks' non-participation in that regard, I don't think is an issue.
So what is the storage options, though? You don't store in the States because of light backwardation, so where do you go to store?
Well, you'd expect that the structure would be such that you can store in any third-party locations that are there. I mean, there are a few around, and then the VLCC market, up until very recently, has been a fairly blighted market. VLCCs are trading at about half the price of an MR, as I'm sure many ship owners in the room know. So there is availability. Now, that also is fairly finite. I mean, that's very much a short-term solution. It's not a structural solution to overcapacity.
So if I could change a little bit, refining and refining products. Sometimes it looks like the product is the tail wagging the dog, and sometimes it looks like crude. So I think some of the changes we've seen, that refinery is a very nice business in the States. It's a marginal business in Europe. It's really about if you're an effective operator, I think more in Europe than anything else. Location, advantage. And then Asia, with the increase in refinery capacity going up over the next 2-3 years, where's the refinery business going?
Yes, I mean, the Asian refining business, East to Suez refining business is having a tough time even before the new refineries come. They have 2 refineries on the brink of entering the market in Abu Dhabi and in Saudi. But before that comes, the pain is already there. Some of the best refineries in the world, which are in Korea, for example, they have heavily invested in upgrading, but they have to export 50% at least of their products. And the demand growth, which Chris mentioned, actually the demand growth slowdown in Asia is very significant. The loss of growth in gas oil markets, both in China and India, is very dramatic. And it's really sort of dramatic. So a lot of these refineries are all designed to produce a lot of gas oil and put on the market, for which the demand is slowed down significantly. So tough problems already exist in the East. The issue really is that in the East, 80–85% of the new refining investment is done by governments as strategic decisions. So if you're a private company, you're going to get caught in competing with groups of people who make decisions strategic, and the economics are not critical to them. So I think the difficulty in the East is likely to become greater, but there is growth. The interesting story in the East is that a whole country's refining system is likely to get shut down. That's Australia, where Chris's company has been involved in purchasing assets of Shell and managing the refinery. We don't know for how long, but you have a whole country which was a demand of 700,000 barrels per day, and the refining system is likely to all close down there, and they become product importers. So give some room to product imports in a way that nobody expected. The US, of course, they are all doing very well, and there are smiles on everybody's face, even now, but that has a shelf life too. 3, 4, 5, 7 years. Best refineries in the world are still in the US, and best operators in the world. The location, the Gulf Coast, is great. Latin America would be a market for many, many years to come, despite all the promises of the refining capacity, but it is a market where there is no growth. Even with all the economic prospects of the US, it's flat. Flat in the US is good, successful. So there would be some pain coming later on, but much less severe than the pain that the Europeans have faced.
What's this doing to trading?
Sorry, what does this want?
What's all this change? There's too much crude. There's going to be a lot of refinery products all over the place.
Whatever happens, whatever we say here, something else will happen. So I think that's the story.
You can guarantee that?
Yes.
Okay.
More or less. that's the story of trading. So I think we all sit around and prognosticate before we all go and take the suicide pill. Something will change. So that's one thing we know.
But I think that you may have some significant changes. It's possible that some big exporters, like Aramco, will have more products than crude.
Yeah.
And that is fine because it's the same oil which is going out. But in terms of the management of the crude markets, this may lead to some very interesting questions. If you don't have enough crude, then can you be the boss of crude? But the total amount of oil would be still significant. But I think we are moving to more of a product world than a crude world.
I think one of the other things, and it was on one of the slides, is the dislocation between the relative values of BTU between crude and gas, and coal for that matter. And I think that's another part of the equation which I think we not spending enough time thinking about the emergence of incremental gas, not only LNG but LPG, and what that does to the balances and the economics of refining centers around the world is very, very dramatic, and can be very dramatic. We're going to see, the arbitrage between Eastern gas and U.S. gas, $3 versus $16, $15 to $19 per MMBTU, is unsustainable, and it's just a question of how long and what does that mean.
Who gets there first?
Who gets there first, and how's that manifested?
And, with so much gas, in formula against crude, with crude lower, what's that do to Asia, European gas markets?
Well, naturally, anything priced off the crude market is obviously going to be lower, but that's not enough at this point, so that too will change.
This actually impacts the new projects. All of these new projects, whether you take it in Canada, Africa, Russia, you look at the price of oil of $60, $70 a barrel. Very few of them make sense today. Those who have invested already, the money is gone. So we don't talk about the existing projects, but we talk about the future projects. It's a very, very big issue. And whether you want to go to renewable energy, your subsidies have to go up. If you worry about all of the sort of clean energy, you just have to pay more for it.
To switch a little again once more, is the West African barrel really the stranded barrel in the market that's looking for a home? It's been effectively pushed out of the Atlantic? Is that the marginal barrel that has the biggest impact on price?
I think that's way too simplistic. I think there's a reshuffle of the deck, and obviously the West African barrel is a longer haul barrel right now than traditionally there. But you're seeing, as Pierre intimated, you're seeing a South African barrel, an increased Colombian barrel, to a lesser extent, a Saudi barrel is another 400,000 barrels a day is ready to get consumed in Yanbu. It's a constant reshuffle of the deck, and I don't think it's fair to say that any one barrel is the marginal barrel at this point. It's one has a dramatic impact on the other.
So after a period of low volatility and now high volatility, or higher, maybe not high enough yet, is this the new norm for the next 3 to 5 years?
Fun is coming back.
Fun is coming back?
Yes. Volatility is fun. Last few years, so many banks exit the business. There's no volatility. There's no fun anymore. So now fun is coming back. I mean, you can see the smile on Chris's face.
No, it's him. He's the king of volatility.
Okay.
So.
Okay. We'd like to open up to questions from the audience. We think it's more important that you participate, and we can get you out to lunch on time. So, any questions, please?
They are hungry, I think.
They are hungry, huh? We should feed them.
Question.
Yes, Herman, please.
Herman Franson, EIG. I have a question actually for Fereidun, who is one of the top experts of Asian LNG, Asian gas markets. If we are talking now about lower prices and we don't know if and when it will bottom out, what will be the impact if this happens at a time when the first US LNG projects are coming onto the market and next year, early the year thereafter?
Well, the thing to keep in mind is that oil is like dating, gas is like getting married. By that I mean that in oil you can change your mind, but in gas you cannot change your mind. So the US volume which comes in is already sold to somebody. Not necessarily resold to end user, but there is a lifter who's already signed contract. So it is going to come and it's going to go to the market. The price of gas in the US seems to be independent of the price of oil for now, though I am personally convinced that with the low oil prices, the subsidy that oil gives to gas will disappear and gas prices have to go up to carry their own weight. Where the gas prices are higher and they are being carried because of the low crude prices, I think because of the high crude prices, when the crude prices come lower, we have to have an increase in the gas price. So when we add that, then the US gas could be easily more expensive than oil index gas. The problem is that the oil index gas contracts, which are coming in Australia, they continue until 2035. If you don't like it, that's tough. You're going to pay until 2035. So the adjustment that we expect to see, and in fact, in the LPG business is happening right now, because LPG is like oil. It happens right away. In the gas business, you can have actually dual markets with different prices for many years to come. The Europeans are very fond of going to arbitration and to court. If I'm a supplier, always supplying to Europe is a big hassle. But Asians actually are very polite. There's not one arbitration of one court case in any LNG deal in 40 years. So people are likely to respect the contracts and accept the duality of the price. New projects should be impacted, but the US volumes coming in, everything is sold already. Sold sometimes to middlemen like the oil companies, sometimes to end users. Some of it still has to be resold to end users, but as far as the projects are concerned, they're pretty safe.
Thank you. Any other questions? All right, lunch is served. I'd like you to thank my panel. Oh,
Thank you.
one question, all right.
Yeah.
You must be the bartender, right?
Just a brief question on demand. We've all been talking about where the marginal supply comes out of the market. Where does the marginal demand come in? And so therefore, where are we underestimating GDP growth?
Is China the marginal demand barrel? Is $20 lower crude pick up GDP?
I think part of the problem for incremental marginal demand is that despite the flat price collapse in crude, that's been partially offset, at least with a lot of emerging market economies, with the rise in the relative value of the dollar. So the marginal demand that we'd expect to see there, or the elasticity of demand we'd expect to see, hasn't necessarily materialized yet. Where it comes in and when it comes in, I think that's something we're all grappling with.
I think it will take time, though. Yeah.
It's going to take time.
Yeah.
I think if you keep in mind that, let's say in China, the price of oil is set by the state. It is market linked. But if the prices tomorrow go down, the state will take some of the prices down, but not rapidly. It's not immediately moving up and down. So some of the other countries, like India, are taking the opportunity of lower oil prices to try and move and deregulate. Pretty much the oil prices in India are now at about international market, and the government intends to make it a firm move. And then in the future, if it goes up, it's not my problem. So Indonesia, with the new president, they're ready to deregulate and really move to the market. So the lower oil prices give the ability to deregulate, and that kills a great deal of demand by itself, because the sort of cheaper oil has given incentive for demand to grow. Now the oil becoming more expensive, although the price of oil is lower. For the consumer, the oil is more expensive as the prices have been deregulated. So marginal demand as such from the expected places that we see GDP growth at is not likely to come, because many of them are actually paying market prices for the first time.
Heavily subsidized economies.
Yes.
In the East. Okay. Well, thank you very much for your attention. Enjoy lunch.
Thank you.
Thank you. Thanks.